In this video, I cover how money printing is reaching insane levels right now across the world. We briefly touch on what that means for inflation expectations, what's going on in the real economy right now, and also how all of this will affect the stock market this month. Hello everyone, it's Sajjad. I hope you have had a great start to the week after the crazy Black Friday weekend. So first thing I want to start with is just briefly touch on what's going on in the housing market. Now I'll do a separate video update on this. What we saw in news recently is house prices climbed 6.5% from a year earlier to an average in the UK at the moment of £229,000. In terms of month on month, this was a 0.9% increase, and apparently this is defying the pandemic and economic crisis at the moment. There were also reports that the mortgage approvals reached a 13-year high. Now apparently this is all just a massive surprise, but we know here that this is no surprise at all. Bubbles only really burst when the government stops putting band-aids on everything and printing free money, because all that ever really happens is all of that money just gets funneled into assets. But we'll go over that in depth in a separate video. So speaking of money printing, this is what Italy's doing at the moment. They've just now approved a fourth stimulus package to support businesses hit by the latest restrictions. This package is now worth 8 billion euros. So increases in lots of cash handouts for workers, especially those in tourism, and further delays to tax deadlines. And just to give you an idea of debt ratio, you can see here as a percentage of GDP, this stimulus package will push them all the way up to 160%. Canadian Finance Minister Chrystia Freeland unveiled a $40 billion package of new spending over a period of 2 years. So we're really seeing fresh new stimulus around the Western world. And what are we seeing in terms of stimulus overall as a percentage of GDP? Well, this is a very interesting chart. And this is updated as of October 2020. And you can see here, Japan is still way in the lead with regards to fiscal measures. Now, they've been doing it forever, so not a massive surprise. But the big one is the United States. Will we see a new stimulus package announced very soon, possibly any day now? And you do actually begin to wonder, is this the world we now live in with these constant kind of stimulus packages? Never-ending bubbles in assets, central banks printing money, we consuming that money by buying stuff, mostly stuff that nobody actually needs. GDP's boosted so the economy appears strong, and this ocean of debt is just continuously recycled over and over again until someone actually pulls the plug. Is that what we're doing at the moment? Well, the interesting thing is the effect that it's had on inflation, or more accurately, deflation. So in this chart, you can see recently in Germany, Europe's largest economy, we've actually seen the steepest decline in the inflation rate than we've seen in more than a decade. The rate actually dropped to minus 0.7% from minus 0.5%. So again, scary scenario here. The more and more we see in terms of fiscal stimulus, but also regards to central banks, bond buying packages, etc. And we're not getting what they're hoping for in terms of targets. We're not getting that inflation. So what does that mean going forward? Are we going to continue to get a deflationary spiral over the next couple of years? Or will we suddenly see inflation and then literally the next day or the next week, that inflation just compounds rapidly like we've seen in certain countries around the world, like for example, Venezuela? Is it going to be a sudden scary event? In my opinion, for the time being, for the short term, I don't see anything really changing at the moment. The assumption is once the economy picks back up, we'll get more of a velocity of money, more transactions, but again, that's not guaranteed. So what are we seeing in terms of the real economy at the moment? Well, in the UK anyway, now we've seen Debenhams actually likely to be liquidated and broken up in the new year. Same for Arcadia. In fact, they've already collapsed into administration, putting more than 400 stores and 13,000 jobs at risk. But they actually already had 9,000 staff on furlough ongoing. So it's unlikely everything the governments are doing is actually going to stop the increase in the unemployment rate, in my opinion. But what are the effects of all of this stimulus stuff on the stock market? So let's get on to that right now. And one other interesting chart I wanted to show you here. Just take a look at this. So this is the massive short positions that asset managers have now on the US dollar. And you can see that in the last decade, we've seen nothing like it. So we're gonna have a look now at the S&P 500, and you have to say here there's no reason why history can't repeat itself again, why another massive stimulus package from the US government won't result in stocks pushing up further way past what their actual valuations should be. And in my opinion, one of the main reasons for that is eventually a lot of this money gets funneled not only directly into the stock market in terms of investment, but also in terms of increase in retail sales from that extra money, which means that the companies are doing better, which means on paper anyway, quarter over quarter or year over year, they look like they're doing well and they're growing, but the reality might be very, very different. Just before I start, if you're new to the channel, please consider subscribing and turning on your notifications. I do regular stock market updates. And before we get onto the S&P 500, I wanted to talk about the VIX briefly as well first. This is a weekly chart of the VIX, and what I've marked off here is the level of the VIX back in 2009. Let's just zoom into that for a second. Also on the VIX, I want to just mark off horizontal line on the 40 mark here. So the reason I've marked off March the 9th, this was a significant low in the S&P 500. And after that low, we saw the VIX move back into normal territory. So around between the 10 and the 20 level. That's what we saw after that significant low. Let me just superimpose the S&P 500 on here so you can see. So zooming into the chart here, you can see that was the significant low there in March 2009. And at that time, the VIX was around between the 40 and 45 mark at that time. And then it slowly normalized. We had a couple of shocks along the way. So a peak there and here as well in February 2010. But then it normalized for a while. The next time we actually broke out was back in May 2010, which coincided with a decent correction in the stock market at that point. But from then on, the S&P just soared year on year. Let's just compare that to what we're seeing at the moment. I'm just going to drop onto a daily chart now. And you can see again, the VIX spiked massively in early March. But let's just zoom in a little bit since then, since the March 23rd low. So there was a significant bottom in the stock market on the 23rd of March. At that time, the level of the VIX was actually much higher. It was over the 50 mark. And since then, we saw the same thing. So the stock market continued to rally, VIX normalized, apart from the odd shocks that corresponded to corrections in the stock market. We saw a more significant one there. But remember, of course, it was election year. So this was literally a couple of days before the election. And now we're back into normal territory. And this is actually the lowest level on the VIX we've seen for a while. Let me just remove the S&P chart. You can see this gap here in the VIX on the 21st to the 24th of February. We're now actually filling that gap. So the main scenario I'm watching at the moment is completion of that kind of gap fill there, and the VIX stay here in normal territory for the short term, at least for the coming, say, 3 or 4 months, while the stock market quietly rallies upwards for, in my opinion, the final stock market rally. As per my last update, there's been a lot of volume traded, especially in the Nasdaq over the past couple of weeks as we've gotten the election out of the way. Now, of course, there's a lot of politics at the moment with regards to Trump conceding and further stimulus bills. So there is still a little bit of drama, but we can pretty much say that in terms of stock market worries, there isn't really anything that I can foresee coming up in the next kind of couple of months over the Christmas period. And you can see here quite clearly, kind of like an ascending triangle building up here in the short term in the last few trading sessions of the last couple of weeks. And I believe because the volume has been increasing, the move could be very strong. I wanted to show you very quickly on a couple of large cap stocks. So let's have a look at Amazon briefly. And Amazon, you can see here, I'm just drawing the trend lines. It's sideways consolidation at the moment, but you can see price constricting more and more. And I think we're very close now. And if we get that bullish breakout, I really think it can take off, because again, in the stock market, if you're brand new to kind of technical analysis and classical analysis, what you'll find is there are periods when markets and stocks trend and periods where they go sideways in terms of consolidation. Now, it depends on the market, but generally, market actually can be in consolidation in certain stocks more than it's actually trending. either upwards or downwards. However, the greater the period of consolidation, usually the larger the move. And this sideways consolidation, likely a triangle, but it could be a complex correction sideways, will result in the resumption of this upward trend. And I think, again, this is most likely to happen in my opinion. But we have to keep an eye out. If we get the lower probability scenario where we get a breakdown in price, then we have to reevaluate what's going on here. And that's where we can have a more open discussion about whether we've actually already seen a top in the stock market. I don't think that's the case at the moment. I think we're more likely to see that in 2021, but that's definitely there. Now, I'm going to do a separate video on this, but I think 2021 will be a very interesting year, if not scary year, to be honest. I have a theory on how everything is going to unfold, and that's what I'm going to discuss in this new video. But I think where we're going at the moment is worrying, because I believe what's going to happen, just briefly here, just to give you a bit of a flavor of what's coming up, I think what's going to happen is, obviously we've got these vaccines now, nobody wants to take them, so I think governments, what they're going to do is encourage people to take them. Best way to encourage anybody to do anything is to give people stuff for free. So either no cost, or here, have some money, have some vouchers, something else, and take the vaccine. That's only the beginning. I think after that, we're going to get possible digital currency. We might even get kind of money cards or something like that. That might actually be in the pipeline at the moment, scary scenario. And then in that scenario, again, free money to encourage people to do that. And then what's going to happen with that existing cash in the banks? Who knows? We'll have to transfer it all to here. And then they're going to tax you at source anyway to try and make back all of this money that's been printed this year and disappeared. And I think we're just heading into this surreal scenario which historians and economists, even hundreds of years ago, actually were warning everybody about. So yeah, there you go. Let me know what you think in the comment section below, and I'll do another update very soon. Thanks for listening.